professional dancer. He wasn't a stock market expert, and he got interested in stocks because one of his customers had given him a tip or couldn't pay him, so he ended up investing in a Canadian mining stock, and he made some money. Now, what was interesting about Nick Davos, remember, this is pre-internet days or faxes or anything like that. He was on tour with his sister all around the world, and they relied on telegrams and cables. And actually in the book, they've got copies of telegrams and cables. And if you know anything about telegrams, it's funny, it's a bit like what Twitter is today. You only get a little bit of space, so you have to write things very, very quickly in shorthand. And he would telex the orders back into his broker, who was based in New York. So imagine, Davos is all over the world, very little news at that time, very hard for you to be in contact with Wall Street. But you know what? He did really well by not being on Wall Street. So you remember what I said earlier about all the iPads and all these great technology? Well, Davos was totally the other way around. Davos was trading stocks from many, many miles all over the world and just sending the orders in. The only thing he would do is get prices from the back of barons at that time. So let me tell you a little bit more about Davos and the box system. So Davos had no computer. He would draw the pencils by the boxes by hand. Of course, you can do it by computer now. He never read the news. Whenever they sent him barons, he'd throw the newspaper away and just keep the prices. His system was trend trading based. At that time, he only went long, but of course, we could also go short as well. And whilst all this happened in the late 1950s, 1960s, it's still valid today. All right, so don't let anyone think, oh, it doesn't work anymore. So this is a stock called Lallard. Again, don't need to know anything, but this was actually one of the first companies that invented filter tips for tobacco. And this is, look what years we're talking about here, 1957, 1958, 1959, but the same sort of patterns. This could easily be today's Baidu. And if you can imagine what the box system is, as the price is moving up, he's raising the stop losses and locking in profits, but he's staying with the trends. And because he's all over the world and he's not on Wall Street, he lets these trades run. Two other stocks, Texas Instruments, which of course is still around today, but remember Texas Instruments was a pioneer in early electronics. Zenith Radio. Radio was a little bit like internet stocks back in the day. You know, radio was the big thing. But again, same sort of patterns. IBM, this is obviously right up to date. This is IBM, but IBM with the box system is doing exactly the same thing. Yeah, so you imagine what you're doing as the stock is moving up. You're moving your stops, locking in profits, but just riding the trends. And this is straight out of Davos's book. I found that, you know, because what happened, I remember the history of Davos, he was away for a couple of years on the tour, and then he came back to Wall Street and he started losing money because he was actually starting to not trade the system. He was getting too much influences in New York. So in fact, he did much better by being away on tour than he did by being on Wall Street. So this idea that you've got to be checking your prices every 5 minutes, you've got to be glued to the screen, it can actually work against you. And in fact, in my history, I've always done better by not being glued to the screen. And you know, that's what Davos basically found. When he came back, he started actually losing money. So summary to the Davos box system. The company names change, but the patterns remain the same, and I've already been, I said that, started up. Davos really was trading the 80-20 rule, really. Most of Davos's trades were being stopped out, but he wasn't losing much money. But then when he hit the big ones, the big Lallards, the Zenith Radio and what have you, that's where he was making the money. Davos wasn't bothered about missing 2 or 3%, because remember, he's always behind. By the time he got the telex or he had the newspaper sent, he was normally a week or two behind. So all this idea that you need real-time data and all the rest of it's nonsense. But what Davos was interested in, he's interested in the 50%, the 100%. He wants the big moves, which is what I'm interested in. I don't care if I've missed 2-3%. It's the big move that I want. And I say he wasn't bothered about news and the why. The price told him everything. And as I say, the advantage we have, old Davos, he had to do this by hand. You can filter all this now with a computer. That's where you be smart. Use the technology to your advantage. Yeah, let it work for you. And that's this good thing that we can do. And as I say, we can also short as well as go long. In his day, I think he could go short, but he had his system, he was just trading long. So he would have made a lot more. Let's say, the Davos box idea, ideal for end of day traders. or weekly traders, because